Welcome back. Charts are used by traders to conduct technical analysis. As we know, the main reason is to come up with a view on potential future price movements. If you develop into a technical trader, charting will be one of your most important tools. And by the end of our courses, reading and analyzing charts will become second nature.
Sounds good. Are there different types of chart? I've seen a few different ones.
There are many different types of charts, but in this lesson we will be looking at the most popular three: line, bar and candlestick charts. Let's start by explaining what a chart actually is. To explain it in simple terms, a chart is a sequence of prices for a particular financial security plotted over a selected duration of time for a predefined time frame.
Okay, so how exactly do we read charts?
Well, let's look at this chart here. The vertical axis represents the price scale. The horizontal axis represents the time scale. Prices are always plotted from left to right in chronological order. The most recent price action is displayed on the right-hand side of the chart.
Okay, I'm with you so far. You said the data is plotted for predefined time frame. What do you mean by that?
If you look here, you'll see the time frame. This particular chart is a daily chart, which means each data point represents a full trading day. If I change it to monthly, each data point represents a full trading month. If I show you a minute chart, then each period is a minute. Remember, for all the charts that I'm showing you, it's still the same financial instrument.
Yes, that makes sense. And how much data do we need exactly? What's the best time frame to use?
Well, it really depends on what type of trader you are. Your trading style and investment time frame normally dictate the chart time frame you'll be using. Long-term historical charts, like those that are monthly and weekly, are typically used by investors. Passive traders normally use daily charts. Short-term traders tend to use the intraday time frames.
I can see the time frame called tick on the options there. What's that mean?
A tick is every time that market changes its price, so a tick chart has a tick for each data point. Markets can update multiple times a second, so this chart can move very quickly. It's normally used by very short-term traders.
Okay, so choosing a chart time frame is all down to the type of trading that suits my style and length of time I intend to trade for.
Well, pretty much. Later in the course, we will also look at how to use a combination of long and short-term charts for the same instrument. In the trading style that we are teaching you in our more advanced courses, long-term timeframes indicate a prevailing trend and short-term timeframes are used for the execution of the trade. So a solid understanding of timeframes is hugely important.